After keeping interest rates near zero since early in the pandemic to heal the economy and bolster the job market, the Federal Reserve has changed suddenly into an inflation-fighting machine. In today's video, we're going to discuss how Fed's decision relating to interest rates could possibly lead to a recession. But before that, make sure you press that red subscribe button along with that tiny bell icon to get updated every time we post new videos. Let's get started. The Federal Reserve said Wednesday that it'll begin a series of interest rate hikes in March, reversing pandemic period programs that have fueled hiring and growth and stock market earnings, but also stubbornly high inflation. Deciding what to do with interest rates isn't always easy. Even if you've only been loosely following the Fed, you'll know that U.S. central bankers have had a hard time determining when to cut off the world's largest economy from stimulus. Officers in early 2021 said they would keep taking up rates at record lows to give millions of sideline workers more time to find a new job in the face of advanced inflation. But as the months went by, joblessness sank, fewer workers jumped back into the labor force, and inflation kept boiling, ultimately reaching a 40-year high. At the start of 2022, officers are now abandoning that patient stance, preparing to hike interest rates at least 3 times this year. Officers on the Fed's rate-setting Federal Open Market Committee are assigned with making those opinions, generally at 8 meetings a year. The Fed looks at a broad range of profitable pointers, dissecting what's going on with employment and inflation. Chairman Jerome Powell said at a news conference that inflation has gotten slightly worse since the Fed last met in December. He said raising the Fed's standard rate, which has been pegged at zero since March 2020, will help high prices from getting settled. Seeking to calm fears that advanced rates might hurt the economy, Powell said the central bank can manage the process in a way that prolongs growth and keeps joblessness low. I think there's quite a bit of room to raise interest rates without threatening the labor market, he said. He also said the economy is important, healthier now than when the central bank last raised its standard short-term rate from late 2015 through 2018, when it did so veritably sluggishly. His comments suggested that the Fed could raise rates several times this time. The Fed's rate hikes will make it more costly over time to borrow for a home, automobile, or business. The Fed's intent is to temper profitable growth and cool off inflation, which is at a 40-year high and eating into Americans' paycheck earnings and budgets. The central bank's rearmost policy statement follows dizzying rotations in the stock market as investors have been gripped by fear and doubt over just how fast and far the Fed will go to reverse its low-rate programs, which have nurtured the economy and the markets for years. Therefore, whatever decision Feds make will have a huge impact on its economy. That's all for today's video. Let us know your views in the comment section below, and don't forget to like this video before leaving. Thanks for watching.